For weeks now, Bitcoin has been in this weird state of, well, suspended animation. It's just been stuck, locked in this super tight range right around $70,000. It's not crashing, which is good, but it's not soaring either. It's just there. And in this explainer, we're going to figure out exactly why.
So what's really going on here? Because this isn't just random market noise. No, what we're seeing is a price that's trapped in a fierce tug of war, with some unbelievably powerful forces pulling it in opposite directions. The real question is, who's on each side of the rope, and why isn't anyone winning?
So there's actually a name for what we're witnessing here. It's called forced equilibrium. Now don't get this confused with a healthy, balanced market. This is a super high-tension stalemate. Think of it like two equally matched arm wrestlers, right? Muscles are straining, knuckles are white, and neither one can gain a single inch. It looks stable, but it's incredibly tense, and you just know it can't last forever.
Okay, to really get this, we've got to meet the teams. So, first up, let's look at the forces that are pushing the price down. What is creating this massive ceiling that Bitcoin just can't seem to punch through? Well, the answer starts with the very people who bring Bitcoin into existence.
This right here, this lays out the brutal economics that Bitcoin miners are dealing with. Now, their cash cost, that's just the raw electricity bill, is around $60,000, but their all-in cost, which is everything else like salaries, debt, equipment, that's way higher, somewhere north of $74,000. So here's the kicker. At the current price, they are literally losing money on every single coin they mine.
And this is what some analysts are calling the valley of death. The market price just isn't high enough for them to be profitable. This creates this relentless, constant pressure. Anytime the price even tries to rally, miners are basically forced to sell whatever new Bitcoin they have just to pay their bills. They've become this constant source of selling that just caps any move up.
But hold on, it's not just the miners. The big institutional players, the so-called smart money, they're getting in on this too. They're using these complex option strategies, and the most popular one is called a covered call. Now, in simple terms, they're selling contracts that are basically just bets that the price won't go much higher than $75,000. This has created a massive, invisible wall of sell orders just waiting right above the current price.
And the institutional pressure? Oh, it doesn't stop there. Just look at this number. $12.6 billion. Let that sink in for a second. That is the combined paper loss for some of the biggest corporate Bitcoin holders as of early February. Yeah. These are the same companies that were once seen as the ultimate bulls, the biggest cheerleaders.
See, their average buy-in price is around $76,000, which means these giants are now officially underwater. And this is a double whammy. First, their ability to buy more Bitcoin and pump the price is pretty much gone. And second, it creates this chilling fear in the market that if the price drops any further, they could be forced to sell their huge stacks, which honestly would be catastrophic.
Okay, so you're probably thinking, with all that insane downward pressure, why hasn't the price just collapsed? Well, let's look at the other side of this tug of war. What are the powerful forces that are digging in their heels and creating this solid floor under the market?
Ironically, the first line of defense comes from the miners themselves. Yeah, the same people pushing the price down. Remember their $60,000 cash cost? While it's causing them all this pain, it also acts as a hard floor for the entire market. Think about it. If the price were to dip below 60 grand, a lot of miners would just have to shut off their machines. That means the supply of new Bitcoin would shrink, and basic economics tells you that scarcity would naturally push the price right back up.
Institutions are also propping up the price, and in a really clever way. They're buying these derivative products called protective puts, which are kind of like insurance against big price drops. Now, the market makers who sell this insurance, they have to manage their own risk. And how do they do that? By automatically buying Bitcoin whenever the price starts to fall. It's like a built-in safety net that unleashes this powerful automated buying pressure during any big dip.
Now, you might have seen the headlines about all this money flowing out of the big Bitcoin ETFs, right? Sparking all these fears of an institutional exit. But the data actually tells a different story. Yeah, there were some initial outflows when early investors took the profits, but look at the inflows. Money is already rotating back in. This isn't an exodus. It's more like a strategic repositioning. Institutions are not abandoning this market. They're just using this period of stability to get back in at better prices.
So, we've got this internal stalemate between the buyers and the sellers. But there are also these external forces. You can think of them like referees holding the rope steady, and they're preventing either side from getting an advantage. These factors are creating a total gridlock.
So what's one huge thing that could break this tie? Well, regulatory clarity from Washington would be a big one. But
Is that coming? As this quote from a Federal Reserve governor makes painfully clear, no, don't hold your breath. The key piece of legislation here, the Clarity Act, is completely stalled. And all that uncertainty is keeping a ton of big, conservative, long-term money just waiting on the sidelines.
And why is it stalled? Well, it all boils down to this fundamental, almost philosophical disagreement. The traditional banks, the old guard, they argue that crypto rewards from things like staking are basically just interest, so they should be regulated like a banking product. But the crypto industry says, no way, arguing that rewards are a technical incentive, something totally different. And until they can solve that basic disagreement, no real progress is going to be made.
At the exact same time, that popular story of Bitcoin being digital gold is really starting to weaken. I mean, during all this recent global uncertainty, real gold has been hitting all-time highs, acting like a textbook safe haven. Bitcoin, on the other hand, has been trading almost in lockstep with risky tech stocks, and that makes investors really question its role as something that can diversify a portfolio, which, really reduces its appeal when times get tough.
Okay, so we've got a powerful ceiling, a solid floor, and a bunch of external factors keeping everything in this massive gridlock. Which brings us to the final and most crucial question. What could actually break this tie? What event could finally give one side the strength to win this insane tug-of-war?
Well, according to the analysis, there are 3 main potential game changers to watch for. First, what's called a miner purge, where the weakest miners finally go out of business. It'd be painful short-term, but it would get rid of all that constant selling pressure. Second, a regulatory breakthrough, where politicians finally get their act together and reach a compromise. And third, a true liquidity injection. That means the Federal Reserve doesn't just talk about easier money, it actually starts pumping it back into the system. Until one of those happens, we're probably going to stay stuck.
And that leaves us with this final thought. That $70,000 mark, it's not just a number on a chart. It's the exact focal point of a market that's in a massive transition, trying to balance the pain of its creators, the new strategies of its institutional players, and the frustratingly slow pace of regulation. So the question you should be asking isn't just when it will move, but whether this tense, coiled-up stability is the new normal, or if it's just the quiet before the storm.